to Plain Talk. Here as Steve Laska, here as usual with my partner Matt Gomoll. And Matt, I believe we're going to talk about the big news today coming from the Fed and the rate cut, which I think we expected, and we expected this number, but the goal today is maybe put a little bit more context around it, what it means to our clients and what it means kind of going forward for them, not just on markets, but if they're in the market for a house and things like that. So what's on your mind today when it comes to things like the Fed cutting interest rates?
Yeah, so this is a good one because we've kind of talked around interest rates for months now. Um, President Trump has certainly brought it up for months. And so it's been a topic of conversation. If you're out with friends, if you're, talking to your advisor, we're talking about these things frequently. What finally happened was the Fed lowered their overnight lending rate, the Fed rate, from 4.25 down to 4, right? So they do ranges. So it's 4 to 4.25. It used to be 4.25 to 4.5. So it's a quarter point lower. That was expected. Frankly, all the markets today are not even reacting. There was a little bit of volatility in the stock market, and that is based on the language that the Chairman Powell used in his press conference afterwards and the prepared statement he makes. Bond market didn't move at all. It is, again, expected direction. So we expected a cut. We expected this number. 0.5% would have been a surprise at this point. So right on track for what everybody was kind of planning on.
Would have been a surprise, but the tea leaves are there. So the vote was 11-1. And when you first read that headline, you're like, somebody dissented on the rate cut. They did, but it's because they wanted it to be a half, not a quarter.
Yeah.
So there is a little bit of I think there's some writing on the wall that you had somebody staunchly saying, I think it should be more. And what came out of it as well, I believe, is I don't know that Chairman Powell necessarily loves it, but it's never one person's decision. We kind of always lay it at his feet. But I think the governors are saying, "Hey, we're going to do a couple more of these this year," and that's kind of what's on the horizon right now, and we might see that built into the market soon. The Fed trades in, they literally trade in rumor. I don't know if you know this, but I had the opportunity maybe almost a decade ago to go to a dinner where there was a Fed governor speaking, and she very directly said, "We trade in rumor a little bit. Like we temper markets or we kind of kick up markets a little bit if we kind of put out there, well, we might do this or we might not do this." And so that's why they're not. I don't think they put a stake in the ground. I don't know what your opinion is today. If we're doing two, which is why the market doesn't just go crazy. Two more. They're saying we might do two, which I think to people like you and I that have been doing it for a while goes, it means one definite. It doesn't mean two definite.
Yep. Yeah. So a big part of this whole ordeal, the announcement of a cut is just one data point. Obviously, that is a shift that everybody's going to react to or already did react to. But then it's all the things they say. They put out a dot plot, which is all of the governors who are voting put a little dot over periods of time to think what their rate is going to be over the next few years. They put out the Powell releases a prepared statement, and then he takes a press conference, and he's very deliberate in the things he says. Some of the things he says, this was a risk management cut, right? So it's kind of like they're seeing a little bit of elevated risk on the employment side. He referenced those job numbers that kind of revised and disappeared over the last several months as a indication that the job market is a little weaker than they expected. And remember, they have that dual mandate: price stability, that's inflation; full employment, that is the unemployment level. And so while inflation isn't fully tamed and back down to 2, they feel like it is directionally, it's going in the right direction. It isn't at a risk of spiking. So we can afford to cut a rate while our inflation targets are still above target, because we want to deal with this soft unemployment. And there is going to be a balancing act for the next several meetings, where I think every time it comes, so the next meeting I wrote down, October 29th, they'll make an announcement. December 10th, they'll make an announcement. I think we're on track for a quarter point in each of those. However, if there's a big spike in inflation and employment looks solid coming into the October meeting, maybe they'll pause, right? Maybe they won't do anything. Maybe they'll resume in December, right? So it's a very much meeting by meeting outlook they have.
So, Matt, I've been doing this, going back to the early 90s. And I want to bring up a couple of things I think I've talked about in other plane talks. One, that's a self imposed mandate. That's
Yes.
just like them sitting around and going, "This is our mandate." Like nobody gave them that. Like there wasn't direction. And I'm still a little twisted on. I believe in Fed independence. Absolutely, it's what makes us the most trusted currency in the world. But I also believe the Fed should be whoever's elected president. They should at least be counseling each other. Like, here's what I'm trying to do. Here's what you're trying to do. And monetary policy should tie into economic policy. It really should. So back when I have a degree in finance, I've taken lots of economic classes, and it used to be taught that 4% inflation was a healthy economy. Now, we've moved away from that, and I think it's for a couple reasons. So one thing I'm concerned about, and not for our clients that are older that own homes, that and this isn't my concern for the markets. All inflation's not equal. Like last year, like vegetables were inflated by 9%, right? Some stuff's coming down while other stuff's going up, so it kind of evens out. But housing's an issue. Like housing prices are absolutely astronomical. And you and Lindsay are at an age where you both worked hard, started your family a little later, got in that housing game early. There's a lot of people your age and younger where housing is becoming something, and it does tie to inflation, where it is like it's a non-starter. Somebody in their mid 30s or even like early 40s, like you, if they weren't or if they're not already in the home game, very very difficult to get in it. Now, the other thing I want to point out, and I'd like you to respond to both, is the job numbers. Right? The reason why like most people are prognosticating the job numbers does have to do with the immigration crackdown. So a lot of those jobs that were lost earlier in the year and why people didn't necessarily see the effect on stuff, because a lot of those people were what would be considered here illegal immigrants, right? They were here, they were working, they were paying taxes, all of those things. But when they left the rolls, it wasn't people that had social security numbers and things like that that were leaving the rolls. So there's a little murkiness even in the job readjustment of the million two. In fact, from a distance, it looks like that matches up with deportation numbers fairly closely.
Yeah, I'll hit the job one first. Powell mentioned that, like, he is citing the reduced immigration. So not no, not only a slowdown of immigrants coming, but also immigrants leaving as absolutely a factor in the job numbers, right? And I think the job numbers are so messy right now that they're not a great data point for anybody. Frankly, they're just really there. It sounds like the Bureau of Labor Statistics has some auditing they got to do to figure out what's going on. Part of it is just respondent rates, right? The initial job numbers that are put out for any given month are based on whoever. It's like a poll, right? Whoever answered gets included, and then they do math to try to say, well, this sample we have, if we plus it up to represent 100%, this is what it should turn into. Well, if 60% of companies answer the job statistic survey every month and 40% don't, well, that's not super accurate. And as more people answer it a month or two later, it gets more accurate, it gets into the 90% range of people who've responded. And then they released those revisions saying, yeah, once everybody answered, we were way off. That's a problem that they really need to try to figure out. How do we just get more responses, better numbers up front? Otherwise, we're making announcements that are completely irrelevant, and the market's going to start to figure that out. They're going to be like, all right, you made an announcement. I'm either going to just ignore it or discount it by X amount because I've seen a trend of you're off by this much every month. into the housing issue. Yeah, you're absolutely right. And it's such housing is such an interesting problem. Everybody who owns a house does not want their house to go down in value. It is for most American families the store of it, the majority of their wealth. It's not unreasonable to say 50% of a normal family's household wealth is trapped in that home equity. So
At least.
nobody wants it to go down. But at the same time, we all kind of acknowledge, yeah, there's not enough housing. Housing is too expensive. Well, I want it to be less expensive with also not letting my house go down in value. How do we do that, right? Like, how do we create more housing without devaluing the existing housing stock? And then add to that just it's one thing if, wherever you live, a starter home's, call it 300 grand. If you're in a city, it's probably hard to find in a decent sized city a house cheaper than that. And if you're 300,000 at 6.5% mortgage, that's a lot harder than three and a half, or 300,000 at 4%. So that mortgage makes an expensive housing more accessible to more people. So that's why this is such a big deal for getting that rate down. Obviously, it is not. The other part I'll mention there: builders borrow to build, and so the interest rate absolutely matters. It not only matters to the borrower who wants to buy that house, it matters to the builder who needs to finance the construction projects. And so if they're borrowing at, you know, 8, 9, 10% on a business loan, it's hard to, you got to price that house pretty expensive to break even and, make a little profit. And so it trickles down like that. Their borrowing costs are a problem for housing. Your mortgage costs are a problem. The fact that we don't build enough, the fact that our housing, zoning laws are too restrictive, it's all a problem that the Fed can only do so much of it. And then local politicians need to, step up on the other side.
Yeah, I'll tell you two close to home, like examples of that is so, you know, one of my sons, who you know very well, he and his wife's an emergency room doctor and a Harvard fellow. And, Travis is a healthcare consultant with an MBA. His rent's $4,500 a month. And people are like, why doesn't he buy a house? I'm like, he can't. He could not possibly buy a
No,
house in
not
that area.
there.
And when you're an emergency room pediatrician, you can't live an hour and a half away from the hospital that's in downtown Boston, right? So there's that quandary. On the other side of it, I was telling you that like Cherry and I, like she would like to have a different home, and it just kind of popped up last night, and we saw one, and we went and looked at it. We put a bid in it today, and it's contingent on us, selling one and selling our current home. But for us, so again, I'm 58 years old. It's a little bit of a benefit for me that housing prices at my level have stabilized, and I'm going to move 2 miles away from my current home. Um, but that's people my age. That's not people younger than that. And, Matt, we have some really great tools to help clients with those things. And I say that this isn't a commercial because we don't monetize it. We don't charge for it. We don't make money on it. It's just a tool that I think that you're actually who sourced it for our firm, where we can look at where somebody is when they did the original financing, what their rate is, and just give them a pretty clean look at maybe they should consider refinancing. Because if you bought a home in the last, like I got mine at the right time about 3.5 years ago at 2.5%. It was 5.5% a month later. Then it was 6.5, 7.5. So if you bought during that time, we have some great tools, and I think you and our team are able to demonstrate like a half a point, or in a bigger picture, a point, 1 percentage point is a major savings if you had a significant outlay on a mortgage. Why don't you just give kind of an outlay of just how we can help people, because that's what I want people to know come out of these talks, right? We're talking not just to talk. We're looking at things for them using this information.
Yeah, definitely. So gosh, it was probably 2 years ago, as the rate hiking cycle started and mortgage rates went through the roof. I realized that people who are for whatever reason buying during that period are going to get stuck with a high rate. And I wanted a way to be able to proactively say, hey, we know what your mortgage is. and we're seeing it come down, and let's do something about it, or let's at least monitor it and maybe wait for it to come down a little bit more. Uh, we got involved with that software 2 years ago. Unfortunately, mortgage rates did not
Yeah.
move that much, but they finally are. I just so the way the system works, it knows what your debt is because we tell it. So I just did it for myself 2 weeks ago. Put my mortgage information in there and said, "Hey, find me, like, tell me when I can refinance cheaper than today." I'm not there yet because I was fortunate to get in before the full spike, but I expect in the next probably 6 to 9 months, I'll get a notification that, hey, the mortgage you input, here's a couple options that are cheaper today than what you are in today, in already. And that's awesome for us because the old way of doing it is just occasionally looking, occasionally saying, "Oh yeah, I remember that person's got a 7% mortgage, and we can figure out the cost of refinancing." And then, all right, well, we'll come back to them when the mortgage rates are 6.25 or whatever. And also, when rates start going down, if there is a cost to refinance, so traditional mortgage refinance, there's a cost. With VA refinances, extremely cheap. I've did on my last house, I did probably 3 or 4 refinances every 6 months because it was so cheap to do that thing. It's really just like attorney fees. Um, so that is what we want of an automated system being able to tell us, here's a place you can go talk to this lender, and they're offering today, if there was somebody offering 6, I'd be like, yes, let's go talk to them because I've got these 5 clients who I know are 6.5 or 7, and we should explore refinance. um, so it's a really great system that we just want to have running for anybody who's in that 5.5 or over ballpark. Because right now that's the range that we think we're going to get into, and certainly we can run it for anybody. Uh, if you got a 3% mortgage, oh, we're not going to see that for a hot minute.
Mine's 2.5. And that's the only downside to me maybe changing houses is that
Yes.
it's really hard for me to go away from that. But I also want to explain to people that too, right? Like there's a lot of conversations that they should have with folks like us or others. So one, I think a lot of times people are not using their VA benefits. And the number is much higher now. Because Cherry and I are both veterans, like our eligibility is like $1.5 million mortgage. And when we were first getting VA mortgages, you could only use one person, even if you had two, it was really low. And as you said, I didn't know. I learned last night from him how easy those kind of mortgages are to. He said it's literally like an interest reduction app. It's
Yes.
like almost costless. Like you said, it's pretty low. So those are great wealth management topics for us to talk to people. So as we get towards the end of this, like I did see the other thing I saw today was the CEO of Franklin Templeton. Franklin Templeton manages like $1.5 trillion now. I mean, they're big, and that
Hmm.
family is still in charge. Like the woman who's
Yes.
the CEO, her dad is like the first guy. Ironically, last name Johnson, same last name as the folks that run Fidelity, no relation. Um, but brilliant woman, and she did say, look, the Fed rates, no matter what, all the other stuff that's going on, she's like, these cuts, they'll fire up the market. She's like, because of all the things that you said on building has slowed down because they're borrowing, right? Acquisitions have slowed down because of the borrowing cost. In some cases, even for very big businesses, just expansion of the business has slowed down because of borrowing cost. And the Fed, even between now and next year, if you start to get that Fed funds rate down in the high twos to three, I mean, we got very, very spoiled when it was darn near zero. And I
Yes.
really panicked about that in my experience because I was like, there were no levers to pull had things gone wrong. I do think the Fed and I think the policies for the market are really in a good place right now because they're pulling levers. And even if they go down to three, they'll have a lot more levers to pull. And I think that's good. I think it's really healthy monetary system, no matter what the the angst has been between Trump and Powell and those things, the output right now is we survived the uh, the quantitative easing, the quantitative tightening. We survived all those things. We've survived the run up in the Fed rate without people getting a lot of pain, and we certainly are in a position right now where it's continuing to help us grow our economy, grow our country, and there's still a lot of levers in place that if things got really bad, um, they've got some different things that they can pull. Thoughts?
Yeah, we have the ability to, if we hit a recession anytime in the next few years, yeah, they can drop rates a lot, right? Going from they're four right now. If by the end of next year they're mid threes, if something happens, they can drop real fast. That's stimulative. They also have plenty of room on the balance sheet if they feel like stepping into, right. If they can use their balance sheet, they don't talk about it that much, and it kind of just stays in the world of the bond market players. But it is a feature where if they felt like some sector, housing, mortgage bonds, were weak for whatever reason, they can go step in, buy them, and stabilize that market, right? So they do have ability to do that. If treasuries have an issue because people are worried about our spending and the treasury market goes wild, well, the Fed can step in and buy some, because they're able to do those things. So in general, yeah, if we're on this track of getting over the next year, between this one plus a few more, 1% lower from where we started, that's not bad. It is, all these things trickle through. Again, the Fed doesn't set the rate for anything other than their rate, but every other interest rate in the market is based off of that because it's the lowest, it's the safest overnight possible, like most secure rate. So it's the cheapest, and then everything stacks on top of that. The more risk you have with treasuries or corporate bonds or high yield corporate bonds or private loans or mortgage bonds, all that gets, it's more risk, so it gets a higher interest rate. And so yeah, lowering it makes the cost of borrowing for everybody cheaper just a little bit. Now, a quarter point is not a panacea by any means, and it's not an injection of a ton of money, but it's directionally right, and it will over the next 6 months be even lower. And now that feels pretty good. Add in the productivity gains that AI is already delivering, plus more to come. The spending on capex that companies are doing into new facilities, new manufacturing, new AI build out, like all this, there's a lot of money flowing into the economy, and that's positive.
Yeah,
And lastly, like, yes, the stock market has gone up, so have earnings. These companies are making a lot of money, right? So anytime, and we could talk about this another day, but people trying to point to valuations and point to .com bubble and the that early internet era, those companies were not very profitable and they weren't making that much. Nvidia's making a ton of money, and they deserve to be, worth what
yeah.
they're worth because they are just printing cash every quarter. It's crazy.
There's a natural conflict, and I'll kind of leave it on this point. The natural conflict is that, and this is why the world looks and goes, is your Fed independent, right? Because it also affects what our country borrows money at. So, like, lowering the Fed funds rate at some level, you'd be like, well, the answer is to keep it really low because that's what we'll borrow money from other countries at. And so that's why they keep an eye on it. That's a big reason, not the only reason, but they're looking, going, are you really independent? Are you just going to lower the interest rate so that when we're buying treasuries and T-bills and all that, we as other investors, big pension funds, other countries, we're going to pay, you're going to pay us less. It's proven that we are, whatever arguments they are, this system works really, really well. There's a level of pragmatism.
Mm-hmm.
So I think we'll end on that, Matt. And as always, what I'll tell the audience is you'll see across the bottom of the screen an email where you can email any questions or any topics you'd really like us to speak on. Also, always can call your advisor. Always call anybody here. We'd love to hear from you. I will also say that we're running a survey right now. And so for folks that are watching this, when we run a survey, we're trying to get better as a company, number one. And where we want to make it fun for everybody is we always do a drawing when we do a survey. And when we do that drawing, when we draw somebody's name, we give $1,000 to their favorite charity. So just take 5 minutes or so and think of your hourly pay for that. If you're going to take 5 minutes to fill out our survey and we're going to give it, and your name gets drawn, we're going to give $1,000 to your favorite charity. So thanks again, Matt. And we'll put another one out in a few weeks. And we won't announce the topic because we really never do, because we want to be like whatever's happening right then. Another great session. Thanks, Matt.
Sounds good.